Hi, this is Goernert of Goernert Wealth Management, and this is my Insights and Perspectives podcast. Welcome to the April 18th episode of my Insights and Perspectives podcast. Today, joining me from New York is Canaccord Genuity Chief Equity Strategist, Tony Dwyer. Now, since I've got Tony on the line today, I was going to dispense with my usual 2-minute commentary on the economy and the markets in general, because Tony can do a far better job than I can on it. But in Canada, we're coming up onto tax deadline, so that's at the end of the month. And as I was going over things today, doing my own taxes, I started playing around with the Fraser Institute tax calculator, the tax freedom calculator. And some of the numbers are really amazing. I put in for the average Canadian family, husband, wife, 2 kids. Between the two of them, they make $80,000 a year. And when I put the calculation in, Tax Freedom Day was June 2nd. Now, that's got to make me wonder. So we're going to pay our taxes. Our deadline's going to be the end of the month. And yet, for an average family, Tax Freedom Day isn't going to be for another month after that. Now, that's not just your income tax. That is everything that goes into your tax bill. Now, I live in the Vancouver region. So for us living here, that would consist of your provincial sales tax, your goods and services tax, your property transfer tax, your municipal property tax, your regional property tax, your translate property tax, your school tax, your motor vehicle fuel tax, your translate motor fuel tax, your carbon tax, speculation tax, your empty home tax, if you happen to have an empty home or not, capital gains tax, import duties, employment insurance premiums, Canada pension plan premiums, tobacco tax, luxury car surtax, employment income differential surtax, vehicle transfer fees, employer health tax, corporate income tax, probate fees, hotel tax, and the list goes on. Now, taxes are necessary. I'm not saying that taxes aren't good. They pay for the roads, they pay for the hospital, they pay for the schools, they pay for all the things and the social infrastructure we need. But why is it that we can't have a reasonable conversation on what a reasonable taxation rate is without it being politicized? That's something that always bothers me. I happen to think that paying that much money in tax, more than you pay for food and shelter in a year, is not the best approach. And, people can have differing opinions, but we don't seem to ever be able to have a reasonable conversation about that. And as you're doing your tax returns and finish them all up, just want you to think about that as we once again pay what 1917 was called a temporary war income tax. Now to Tony. My guest today is Canaccord Genuity Chief Equity Strategist, joining me for New York, Tony Dwyer. Welcome, Tony.
Hey, Greg. Thanks for having me.
So, Tony, you've often been, in the past, really focused on the yield curve, and that underpins your bullishness to the market. Now, recently, the market kind of had a flattening yield curve, and there's a lot of consternation in the markets about that. So what do you say to people who say, hey, look, we've got a flattening yield curve, we're heading for a recession, get out of stocks now?
Well, first you have to, Greg, let's talk about why we look at the yield curve in the first place so people can understand why it's so important. The yield curve is simply a statement of what the difference between what the banks get their money at and what they lend it out at. And there's not just banks, there's non-traditional bank lending like mortgage companies that aren't tied to a bank. But if a bank is getting their money at 3% and they're lending it out at 6%, that's a really good thing for the bank. They're going to make a lot of money. They make a lot less money if they're getting their money at 3% and lending it out at 3.5%. So as the yield curve flattens, it makes lending less profitable. Investors tend to get very fearful of a yield curve inversion where the banks are getting their money at actually a higher rate than they can lend it out at. What that does, Greg, is it shuts down lending. And in the U.S., it's a levered economy, which means it's really driven by credit. So when credit begins to slow and shut down, it's a good sign that a recession's coming. And when a recession comes, That's when you want to really get defensive on stocks, but not before.
Okay, so now we had a big correction. Obviously, at the end of the year, it was pretty terrible for all of us. We had a very quick recovery from that. Do you have any fears of a retest? And for people looking at getting in right now or looking at the marketplace, well, what do you say to them as your bullishness? Because it seems like we're almost going back to the stage a couple of years ago where we had the TINA trade. There is no alternative. Is that how you see things? Or so maybe expand upon that a bit.
I think it's the same trade. So the fear about the yield curve drove the market down in the fourth quarter, and then the structure of the market. There's not very many specialists left. The Volcker rule has translated to banks not being able to buy when for their own account. So basically, when the market's in a rapid decline, there's no structure of underlying support. So what we had in the fourth quarter last year was the worst fourth quarter since the Great Depression. And even the bearish camp out there would not argue that we're anywhere near the Great Depression. So obviously something was amiss. The market clearly went down far too much versus what it should have gone down on fear about the yield curve. So basically what I'm saying, Greg, is that if the market goes down inappropriately, getting that back is not inappropriate. So if you look at the market is basically flat since January of 2018. So if I told you in January 2018 that earnings were going to be up over 20% for the next 12 months, even if they're going to slow after that, if they're going to be up 20% for the next 12 months, nobody would think that, and the Fed would take a dovish pivot, nobody would think that it would be flat. So I don't think the reflex rally is any more dramatic than the decline was. It's just neutralizing that. So we do not expect a retest. Frankly, we're looking for a little bit of a pullback because you've had such a big move in technology stocks, but it's just going to be temporary. We're pretty excited here still. Okay,
so, and that brings up a good point, because we walked in last year when the Fed was raising rates, in particular at the in December. I know I was on a call with you, and you were quite shocked that they had such a hawkish policy at that point. So are you convinced that they've learned their lesson, that they're going to be more data dependent going forward?
It really is interesting, Greg, because there's no way. It was incredible. You had a former Fed governor and Stanley Druckenmiller, the famed investor, do an op-ed in December begging the Fed not to raise rates, urging them to not raise rates.
I remember
because
that.
Inflation was declining, right? You had the inflation break-evens, and for the listeners, the inflation break-evens are simply, what the market is saying about where inflation is going to be 5 years from now, and they were declining. So I don't know. Nobody could really look at it and say, well, what the hell are they thinking? And, I guess because they said that they were going to do it, they wanted to follow through. But it was a really foolish move, in our opinion, which meant, when they took that dovish pivot in January, that kick-started a buying spree that only happens at the beginning of bull markets, not at the end.
Okay. Now, right now, we've got a situation where there's a lot of political uncertainty in the States. You've got trade tensions. Can you think back to any other period that's been like that in the past where we actually have had a successful market? Because that's what seems to be keeping a lot of people on the sidelines, in my opinion.
It's really unbelievable. So we always try to make every environment like it's unique. This is almost exactly like 1994, 1995. So in 1994, the Fed, worried about inflation, even though it wasn't coming out in the data, almost inverted the yield curve and shutting down credit because the Fed got too aggressive by raising rates inappropriately, very similar to what happened last year, right?
Yes.
And then in the meantime, President Clinton was under investigation for the Whitewater affair. He was being sued by Paula Jones for sexual harassment. That sounds kind of familiar to last year. And his way of getting that off the headlines was to start a trade war with the world's second largest economy. Again, sounds pretty familiar, right?
Yes.
Japan, Clinton threatened to put 100% tariff on the top 13 Japanese cars. And at the time, obviously, the U.S. was the biggest importer of Japanese cars. And Japan was the same size of the global economy as China is today. And I think that's what people miss. China is definitely the growth engine, but Japan was back at that point, too, in the mid-'90s.
Right, I remember
early
that.
90s to mid-'90s. So you had a very similar setup. And what happened was the Fed got scared because inflation never picked up and they almost inverted the curve. So they, too, in February of 1995, took a dovish pivot. And they ended up going from a hike in February of 95 to an ease in July of 95 after the market was already up 20%. So you got to figure, okay, well, that must, being up 20%, that must have discounted it, right? Wrong. It went up another 15% into year end. Market was up 34 or 14%. The market was up 34% in 1995, and it went up even more. It went up over 20% in 1996, and the Fed kept easing through the beginning of 1996. So I think that the question that people have is it, given the reflex rally that we've had off that December low, are all the positives discounted in the market? And the history of a similar occurrence says no.
Interesting. So now going forward to earnings do seem to be slowing down a little bit. Is that your anticipation, and does that affect the PE multiples going forward?
Well, no, it actually doesn't. So one of the things that has kept people on the sidelines is a few of the guys that do what I do have been talking about this earnings recession and outside the purview of an actual recession. And the current consensus is for a very small single-digit decline, almost 2% decline in earnings for the first quarter of 2019. Ultimately, when it's said and done, Greg, we think that the earnings are going to come out slightly positive because traditionally, throughout the last 10 years, every quarter has seen an upward move in the growth rate from the beginning of the earnings reporting season to the end, to the last one that reports. So if the numbers are, and it's a median 3.5% underestimation. So if the estimate is for a 2% loss in Q1 as of April 1st, by the time the last company reports, it should be a gain of about 1.5%. So we think that expectations just got too negative based upon a global growth outlook that became too sour.
Okay, so looking forward from your point of view, we've got a more dovish to an easing rate environment, stronger earnings going forward. What's going to make you change your opinion on the market going forward over the next few years when you will get bearish? Because I know you have in the past, and I know you will again.
There's only one thing, and it's going to be a shutdown of credit. So you look for delinquency rates to tick up. You look for the credit stress indicators like corporate bond spreads to 10-year treasuries. You look for those to start to get scared. You look for all the credit metrics to not just slow down, but they begin to shut down. And it becomes very apparent that typically what happens, Greg, is the market's doing well during that point, believe it or not, and we tend to ignore it. But, hopefully the people that listen to us won't ignore it this time.
Right. So now we've got some CCC paper that down your way that was getting oversubscribed. So obviously, in my mind, the credit markets seem to be open for business.
The credit markets are absolutely open for business. It's actually pretty historic, the amount of credit generation that's taking place. It's the pension. People keep wondering where the demand is coming for credit in the U.S., and it's coming from the pension plans, where they have to meet a certain parameters of 7%. If they have a high fixed income allocation, which they do, with the highest risk category of fixed income, high yield debt being around 5%, how do you possibly get to 7% with that return? And you have to really lever it. You have to really use excess demand, and that's what they're doing currently.
Interesting. Well, Tony, I just want to wrap it up here. Thank you so much for joining us. This was Tony Dwyer from New York. Thanks very much, Tony.
My pleasure, Greg. Thanks for having me, bud.
Thank you. Bye. Hey, thanks for listening. Don't forget to subscribe and visit us at our website at ggoernert.com. That's ggoernert.com. Thanks again.